Okay, well, welcome everybody to this webinar hosted by FX Street. Today we are going to talk about supply and demand in relation to crypto assets. I don't normally talk about crypto assets at all, but due to the extreme hype, the headlines in the news as of late, so I thought we would spend one session at least talking about this. Yeah, so that's going to be the topic of today. So play these slides. Okay, so crypto assets in general, well, we've all seen the huge amount of interest in crypto assets here over the course of the past months. I mean, these are coming in the headlines. I mean, on most media every hour at least. Blockchain is an incredibly exciting technology. One of its uses is the smart contracts, but there are a plethora of applications for it, so I think it's a very exciting technology. And so of course this is going to kind of force its way into the mainstream investment field. And I think we'll find that as these technologies and these tokens are adopted and people can continue to buy into them, of course the liquidity is going to grow, and it's actually surprisingly high liquidity if you look at all of the crypto assets. I think we're at maybe 700 or 800 billion roughly per day. So I mean, that's a lot. That's quite a lot, and it's growing very, very quickly. And this is just the beginning, as far as I can see. And another important and notable point is that a lot of the tax laws haven't caught up with investing in crypto assets yet. Here in Denmark, if you buy crypto assets for non-speculative purposes, which this is of course very difficult to include if it's speculative or not, then it's considered kind of like buying a painting. You like a painting, you buy it, and if it appreciates in value over the course of your ownership of it, well then you get the profits from it in the situation that you choose to sell. And the same applies for cryptocurrencies, and I think this is likely what's going on in a lot of the European countries at least. And so this of course makes it a little bit of an attractive asset, but it's still just supply and demand. You look at a price chart of anything, it can be crime rates in Ukraine or anything, and you can still see that these levels, these patterns still exist. And of course we're going to be charting crypto assets, be it Bitcoin or whatever. You can see the same patterns very, very clearly on a price chart, and so you can use the same strategy, the same methodology to trade crypto assets as well. And we just have a quick look at the differences, first of all, between fiat currencies. Fiat currencies are traditional currencies, the euro, American dollar, Japanese yen, so on and so forth, in relation to the crypto. Well, a fiat currency is backed by a central bank. We have the European Central Bank behind the euro. We have the Fed behind the American dollar. But cryptocurrencies, I mean, there is no central bank. But there is a tech company, because it's the tech company that created a technology, and in order to raise capital they issue tokens. And so people who believe in the technology that's been created, then they buy a token, and I suppose you could say they get kind of like a stake in the company, but it's not really like that. It's not the same at all as stock. Traditional currencies, I mean, price is affected by many factors. We have interest rates, we have the health of economy, which is measured in the numbers that come out in relation to jobs, unemployment, so on and so forth. We have GDP and other key figures, but none of this stuff affects cryptocurrencies, not directly at least. But all we do have is we have supply and demand, and we have news announcements, and these news announcements are of course made by the company, and this is ultimately an announcement of cooperation with another company, which would of course put wind in the sail of the company who issued these tokens. We have fiat currencies that are highly liquid. If you consider the entire currency market, the FX market as a whole, I think there is a volume of like, is it a couple of $1 trillion daily, which is a staggering number. And then we have relatively illiquid numbers for traditional cryptocurrencies. This is changing, of course, every day because a lot more people are getting involved in cryptocurrencies, but for the time being, they're still very illiquid. And you can see this as well on the price chart. Then normal currencies, they are slightly harder to manipulate, and cryptocurrencies are easy to manipulate. Someone can make a tweet, a negative tweet about a technology that affects the price of a token, and that can send the price of the token plummeting, or it can send it into orbit. And so it's super easy to manipulate, which makes it a very high risk instrument. We have centralized fiat currencies, we have decentralized crypto, because we have, of course, the decentralized ledger. We have a monetary inflation in normal currencies, we have price level inflation in cryptocurrencies. And so we have traditional inflation in an economy, and interest rates are normally used to as the primary tool for inflation and deflation. But we don't have this in the crypto field. We simply have people wanting to buy something, and that buying, that demanding for the asset, gives it a perceived value. And so it's kind of a free-floating entity, at least for the time being. And of course, some of the tools that the central banks can use, they are interest rates to counter deflation and inflation, but we don't have interest rates in cryptocurrencies. Regulation is a bit of a touchy one, and this is also one of the main reasons that a lot of people are staying away from crypto, is because there's no or very limited regulation. There was some regulation that was introduced in Bitcoin trading instances in New York City some years ago, but otherwise there is very limited or no regulation at all. But with banks, of course, we have international regulation. So I mean, there's some very, very key differences between these two here, obviously. Some of the main issues that I see is we don't have the central bank. There is no monetary policy. And so price can do pretty much what it wants. So price deflation, inflation can keep going. It can keep going lower until you lose absolutely everything, your initial investment, or it can keep going until you have an incredible return on your investment. There's no kind of instance that is intervening to help stabilize the price level of a given token. It's simply free floating, and it goes up and down on a daily basis, sometimes as much as 100 or 200% per day. I mean, it's staggering returns. And there's no one to stimulate or help in the situation that the price of a token gets very, very low. People just simply lose their monies, and so it's which is why it's called or considered a very high risk instrument. So fluctuations in price happen very, very quickly. Like I mentioned, someone can make a tweet, an expert in the field can make a tweet saying that his views on a given technology behind the token or cryptocurrency is flawed in some way. I mean, this is going to make the price of that token typically lose value, a lot of value, and this will normally happen within hours, as we've seen here, as we see every day, as a matter of fact. So performing a fundamental analysis on a crypto asset, it's very different, and it's different because if you focus on a given token, I'm sure many of you in the room have heard of XRP, also known as Ripple. It's an enterprise payment settlement network which enables users of this network to settle in real time, which is kind of groundbreaking for sure. And so these people, the organization behind the token XRP, they have introduced a technology that enables real-time settlement. I mean, that's really, really good, and that's an incredibly powerful and valuable technology. And so if you focus on the technology, and you in turn look at the role that the token plays in relation to that technology, well, then it might be worth investing in this particular token. Then we have another one here, 0x, which is a decentralized exchange. So instead of moving through centralized exchange, is how we typically will buy and sell assets today. You trade directly with other people who hold the asset that you wish to exchange for. So this is very exciting as well. Then we have this one here, the UTK, which is UTrust token. And these people have created a for converting crypto assets to fiat assets. So I think they call themselves the PayPal of cryptocurrencies. And I think the technology behind the the UTK token is, or the UTrust token, is a very exciting technology as well. But additionally, I mean, once you've assessed if the technology is interesting, well, then you also have to look at the people who are involved in the company. I mean, who's backing the company? Who's involved in the company? Are they successful people? Do they have a record for doing good things, or do they have a record for doing slightly dodgy things? So these things are very important to be aware of. Is the project open source? If so, this will enable you to see how active the project actually is. Are we seeing daily commits to the source code repository, or are things lying quiet for extended period of time? If so, well, this is kind of a red flag in my optic. I mean, who supports the project? Do we have the technology, the tech company making deals with big companies that have also identified the potential value in the technology, so to the point that they want to implement it, so running pilot projects? Are there any actual implementations or uses of the technology? Yes or no? And this is, I mean, these are very, very important things. If you look at the exchanges, I think you'll see that there are, I don't even know, maybe 1,700, 1,800. I mean, there are, yeah, close to a couple of thousand cryptocurrencies. That's a lot of cryptocurrencies, and some of them are absolutely worthless and useless, and others have real potential and application potential. And so these are really important things that you have to look at. Typically, if you're going to do this on the currency, a traditional currency, you'd have to look at the central banks. You would see what are the central banks focusing on? Are they focusing on jobs? Are they focusing on inflation, interest rates? What's going on? And by being able to assess what they're focusing on, well, this enables you to focus on the same news, and when this news is released, you'll know if it's going to have a big impact or a small impact on the market. And so it's completely different, as you can see here. And also, when you, I mean, I follow this stuff here pretty closely, and I'm reading Twitter every day. A lot of the feeds that some of the main figures behind these technologies they push out, and some of the things that they say, I mean, it seems as if they're trying to maybe say something in between the lines, and so it has a lot to do with interpretation. Did he just say something that's good for the company, or something that's bad for the company? So it can be really confusing. But if you consider traditional fundamental analysis, it's slightly easier, because most people are playing by similar rules, or with similar rules. So if we have a quick look at some of the most popular ones here, you can see here that we have Bitcoin, which is digital gold. We have Ethereum, which is programmable contracts and money. We have Ripple Cash, which is a Bitcoin clone. It's cheaper and faster than traditional Bitcoin. We have Ripple, which is the enterprise payment settlement network. And we have a bunch of other ones here as well. We have this one, Monero, which is quite popular, which is a private digital cash. And there are loads and loads and loads of different ones here. And so you have to look at the company behind these tokens here. These are the token symbols here. What are they doing? Have they made a technology that is actually useful? Are people going to want to use it? Are people starting to use it? Have they actually developed a product? And if so, well, then the token might then gain a little traction and start to see some buying. But we still have the good old-fashioned price imbalances, liquidity voids, imbalances, and trends. And if you can chart it, well, then you can do your supply and demand analysis on the chart. So this is where things get a little bit easier. So let's have a quick look at some charts here. So if we have a look at, where are my charts here? Let me drag this over here. Okay, so if we have a look at this, this is a Dash coin American dollar 30-minute chart, and you can see that if you've watched any of my webinars before, you recognize the software. This is my my supply and demand software, and it's marking off supply up here. I mean, price tested the demand, sorry, the supply here, came back down here, it tested this demand here, and now it left. Now it tested this one again here. We have another one that's untested just above, and you can see that, I mean, price is respecting these areas very, very nicely. We have a nice area of demand down here. If we scroll back a little bit, you can see that we have this kind of a continuation pattern, how price rallied. We had a micro continuation pattern, price left, we retested the area of demand, and then price left. Price came back to the same area once and twice, and here we saw some rejection. And so you can see that this is, I mean, the same thing is going on here that you can see on a traditional currency pair chart. If we have a look at this is the Ethereum American dollar chart, and you can see, I mean, the boxes are below price. What does that mean? That means that you only want to be buying, so price is seeing some buying going on. So we have demand here, so demand is being respected and supply is being consumed. And one of the challenges when, I mean, if we look at, let's have a look at this pair here, the euro dollar, you can see here that we have some really nice price moves with which to hook trades on. If we go into the bigger time frames, you can see we have historical data. So we can see that we have some supply up here, we have some supply in here, we have lovely demand down here. So we have historical data, which is very, very nice. If we go back to this one here, sorry, to the Ethereum American dollar, we go to the weekly chart, I mean, there is no historical data. And so it's very difficult to us to figure out, I mean, how far is price going to go? Here you can say, well, price is going to probably come up to here and have a bit of a bounce. We have a lot of supply in here. We have this one here, we have another one here, so we have quite a few options. If we look here, we have this one here. This is a nice area of supply. This is supply because when price left here, we managed to move below this low and likely take out some demand over to the left. But over here, if we look at this, when we don't know, there's no context yet because it's still quite new. So this has been going, I mean, this broker has price that goes back to the summer of 2016. But most of these assets have existed for longer periods of time, but this broker doesn't. So it makes it very difficult to us to make any valid trading decisions based on that. That said, I think we can all agree that price is moving higher. We can draw our trend lines, our upward sloping trend lines, and to do that, let me, where did that go? Sorry, I was trying to find here it is. So let's have a look. Let's turn off the rectangles. Sorry, it's jumping on the other chart. So let's turn off these rectangles. You can see here. So what we can see here is we can see that price has wriggled nice and efficiently higher. Then price formed this, and then we raced higher. We tested this demand, and then we left. So if we go to the weekly chart, we can probably see this nice and clearly. So we had this really nice area of demand here, and this is interesting to us because when price left here, we managed to trade above these highs very nicely, and price went up, we tested, and now it left very quickly. We have this one here as well. We have a continuation pattern in here, so we can draw something in here as well, like so. And this is continuation pattern because the software is drawing these little white bars here, and this is simply telling us that there's a specific pattern inside this candle that would lead us to believe that there was demand in here. And you can see that when this week closed, price gapped up. That means that there's acceleration, and price went higher and is really racing north here. The Ethereum is really moving higher. If any of you are following it, it's flying. So if we consider that we have the weekly demand here, if we go to the daily chart, we can actually begin to let me draw something here. We can draw from here. We have low, high, low, high. So we can draw a trend line. So we have a low, we have a high. When price left this low, we moved above this, so we can draw our trend line from the low to the next low. So here, so this is the upward sloping trend line. So we can use that. We can draw that just here. We'll connect these two here. So you can see here on the daily chart, we have an upward sloping trend line. Let's refresh that. If we go to the weekly chart, we have an upward sloping trend line, but we're going to have to use different swings. We have this high, we have this low, and then we have kind of this low here which went above these ones. So you could connect these two here like so. So we have like a moderate upward sloping trend line here and a more aggressive upward sloping trend line on the daily chart. If you go to the smaller time frames, you'll notice that we're going to see some more ranging looking price patterns. So if we completely remove all of this and we just go to, for example, the half-an-hour chart or even the 5-minute chart, you can see that we get all of this normal price behavior that we see on any other asset. You can see we have a demand here, price left, it came back down, we would have bought in here, price continued to move higher. We had some demand in here. It was taken out by what? Opposing supply here. So this is the one we'd target for our entry to sell. Price came back to that, and now it's kind of wriggling around just below. And so you can see that, I mean, a lot of the material that we would use to trade traditional assets such as stocks or whatever, or currencies, you can apply to this. The thing that's difficult with the cryptocurrencies is the longer time frames, because they've only gone up. If you go monthly, you can see, I mean, you can't, if we look at all of them that this platform has, this is the Ethereum, we have Litecoin, same thing, we have Dash, kind of same, we have Bitcoin Cash and normal Bitcoin. I mean, they're only going up, 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 up. And this is because they are slowly and steadily and recently rather quickly being adopted by the mainstream. So a lot of people have turned their eye to crypto assets because they've been introduced via media. People are making dizzying returns, and yeah, it almost seems like that you can't do anything wrong as long as you buy. Just buy and hold. That's kind of the standard way to trade these, it seems, because they're all going higher. But you can, I mean, you can wait till price goes up here and buy, but then you have to suffer this psychological and this financial drawdown as price seeks liquidity to drive price higher. People aren't going to want to buy here. It's very expensive. So even the dumb money is going to wait for a better price. And so price came back to here. Here we had like a slight period of equilibrium or kind of parity-ish, the closest thing to it. And then price had a reaction there at this high here, and then it went up again. And so it was looking for any reason to buy. But despite this fact, it's still good to pay attention to the smaller time frames to find out where those areas of supply and demand actually do exist, and wait until price comes back to them. So you can see we had this tiny area of demand just here. Let's have a look at it. You can see it originates from here, this little tiny little area of demand. It's dotted, the box is dotted now because it's been tested. So likely when if price comes back down here again, it's going to move through this one and come back down to this one of the other ones down here. And that's because when we have people's limit orders down here at these extreme areas, they think, wow, $11,000 for one Bitcoin, what a smoking deal. I'm going to put my limit order in and I'm going to buy once price comes back down there. So they put their orders down at these round numbers, the 11,000, 10,000. 10,000 is a big one as well. And this is the liquidity that price is testing when it comes down. So price comes racing down, and it's overwhelmed by buyers once it pokes into here. And the thicker side of the market is to the downside, and as a result of order filling here, the thinner side is to the upside, at least for the medium term. Then it reaches the other side of the market. We have this 4-hour area of supply, which is the blue box, is dotted now because it's been tested. Price fed into that, then we found some sellers. And then price started to drift to the opposite side of the market, which was this 4-hour area of demand. And here we're having a small reaction. And so as you can see, I mean, if you've watched some of the previous videos that I've done, or the videos that Sam Seiden does, supply and demand it's global, it's everywhere, and anything and everything that can be traded. Where there's a demand for something and the supply of that, you'll see these exact same price patterns. If it's cryptocurrencies or telephones or plates or computers or stones, you're going to see the exact same thing. The more liquid the asset, the more fluid and beautiful the price, the movement of price is going to be. And if you have something that's super illiquid, like wine, for example, bottles of vintage wine, well, then you're going to see these enormous gaps, and it's going to be very expensive to trade. But as you can see here, I mean, this is the Bitcoin American dollar cross, and this is it looks like a pretty liquid pair if you ask me. You can see that. I mean, these price movements are pretty nice, and the only reason we have this gap here is because this is exchanged via as a CFD via a traditional broker, and so we have the weekend gap. But if you trade via normal exchanges like Coinbase or Bitfinex or Bitstamp or KuCoin or any of the other ones, well, then you're going to see fewer of these because the market does not close. It's a 24/7 market, and so it's just going to be fluid and nice. And if you consider this one here, this is the Bitcoin American dollar. It's a pretty liquid, relatively liquid. As a matter of fact, Bitcoin stands for it's like a Danish translation. It makes up about 30% of the total liquidity traded in the cryptocurrencies each day. So I mean, there's a lot of demand, a lot of supply for Bitcoin. And if we have a quick look, I've got a page here I want to show you. You can see here, and here you can see a volume, the past 24-hour volume. We have hundreds, thousands, millions, billions, so 13, almost 14 billion dollars in volume. That's quite a lot of volume. And here we have the runner-up, which is Ethereum, which is 7. Then you can see how quickly liquidity goes down. I mean, 47 million, that's nothing, absolutely nothing. And if you sort it from the bottom, you can see, well, some of these are not being traded. Then we have $512 of liquidity. Probably not going to be a very interesting instrument to trade. So ideally you want to find the more liquid ones, the ones that are backed by some serious tech that's being used and harnessed by organizations, and do so on a very limited scale. Are any of you here actively investing in cryptocurrencies? And if so, which ones do you find to be, which ones speak to you the most? Which ones have you bet on? While you guys are answering that, I'm just going to go back to my slides. Okay, so in conclusion, this presentation, if you want to identify a token to buy, I mean, you have to do your homework. It requires that you do your research. You have to find the problem. You have to identify these companies. You have to find out who is on the board, who is a CEO, who is a CTO. Are they good people? The reason I like Ripple so much is because the people, the developers, the minds behind the company Ripple are authorities within the blockchain industry, and so they're very, very important people. They're good people. It's backed by a lot of money out of Silicon Valley. So there's a lot of interest in this coin here, and it's based primarily on the actually it's almost exclusively on the technology behind it. There's a lot of hype about XRP at the moment, as you've seen, but now it's started to kind of dwindle off a little bit, and now price is reaching a more realistic value. You'll notice that the volatility of cryptocurrencies is very, very high in contrast to the more liquid assets like the majors and stuff like that. So you'll see a lot of volatility here, and you'll see increases of 70-80% per day in returns for the same coin. It's pretty phenomenal. And we've seen here that the cryptocurrencies are very vulnerable to manipulation. We've seen this as of late with the XRP token. A big exchange announced that they would not be offering XRP on their exchange, and so this caused an enormous of fear and enormous of regret, and so a lot of people started to liquidate their XRP positions because they were hoping that this exchange would take them on. This would of course introduce more liquidity and demand and bring the price of this asset high, but it didn't happen. A lot of people have also been writing about theories saying that this was purposely done by the exchange, and they're waiting for the asset or the price of XRP to go low enough so that they'll load the boat and then make a new announcement saying that they're going to take on XRP anyway. This has happened with Bitcoin Cash with the same exchange. So it's a little bit naughty, but stuff that you're going to see quite a lot still within this field. And exchange fees are pretty expensive. So if you're exchanging one asset for another, they can get very, very expensive. So you've got to be a little bit mindful of that. So it's more of a kind of a buy a token of a tech company who is solving a really big problem, and you really believe in what they're doing, and you hold it for the longer term, and I think you'll probably do much better. But most of all, be careful with this stuff because it's pretty fast moving, it's very volatile. A lot of fake or kind of dodgy ICOs, initial coin offerings, have been found as well. So people are using ICOs as a way to get a lot of money quickly. So just be a little bit careful and do your research, and I think that you'll probably find that you'll do okay. Cool. I think I'm going to wrap it up at that for now. If you want to talk about, I normally talk about traditional currencies, supply and demand, and currency strength, but I thought that I would touch a little bit on this because it's a topic that's really seeing a lot of interest. But if you want to write to me and hear a little bit more about Pipnotic, feel free to do so. There's my my email there, and there's our website and my Twitter handle. But I thought if you guys have any questions, you can fire them off now, and then we can get to those. Okay. Anyone have any questions? No one mentioned that if you were investing in any cryptocurrencies, and I just wanted to hear if anyone was, and if so, which ones.